Hello, Micah Olson with the Effective Agent team here. Thanks for tuning in to our Becoming an Effective Buyer series. Today we're going to talk about being fast. One of the best ways to get an amazing deal on a home as a buyer is to be fast by being the first people there to see a house. As we get to know what you're looking for and really develop a relationship with your buyer's agent, they will understand what you're looking for, where you want it, how big it is, what the price is, and there will be times where you get a call that says, I think we found it, we need to get out there. When that happens, we need to go. We need to get out, walk through the property. Getting there first is incredibly important. The next part of that is we need to be approved. You need to have a loan that's not just pre-qualified, but underwritten and ready to go. The other thing is we need to have seen and understood what the market is. Now, your agent can help you out with that. We will go with you, we'll walk through, we'll look at it, and we'll say, compared to other properties out here, this is a really good deal. You'll know, like, wow, this house is $10,000 less than anything else. At the end, we need to be ready to transact. We need to get an offer written. Once we know it's time to act and it's time to go. I just had an agent call me a couple of months ago that basically said, you did a really good job with your buyers. An hour and a half after we had accepted your offer, we had two other offers that were both $10,000 above list price. That makes for a happy buyer. That makes me happy to hear things like that. If you're going to be an effective buyer, you want to be fast, you want to be there first, you want to be approved, you want to have seen and understood the market, and you want to be ready to transact. Hey, that spells fast. Be a fast buyer, be an effective buyer. Again, this is Micah Olson, owner of the Effective Agent team. You're watching a video that's part of our Becoming an Effective Buyer series. And in this video, we're going to talk for just about a minute and a half about tapping into a really cool market, unlisted sellers. The most common place that a buyer is going to find a home for sale is on the Effective Buyer website. We have direct back-end access to the realtor database, and we instantly push out information as it happens. That's probably the most common place to find a home. However, we are receiving literally hundreds of requests every week for what's my home worth? What type of marketing should I do as a seller? All kinds of people that are starting to think about, should I sell my house? We've got a system where we put in your information, what you're looking for, and whenever we receive a request that indicates that somebody may be thinking about selling their house, it matches you up. It pops up an alert, and literally, as a buyer, you can be walking through homes that aren't even for sale yet. Nobody else knows that this house could be for sale. We also have in place a list of coming soon homes. We've got agents emailing us, hey, we just took this listing in such and such a county. It's a 3-bedroom, 2-bath home. It's going to be a really good price because the sellers need to sell quickly. We'll receive alerts like that we can key you into. That's a pretty big piece of becoming an effective buyer, having access to unlisted properties, something that we do have here at the Effective Agent team. Hello, everybody. We are going to go ahead and get started. I'm super excited to be talking about investing, especially in Utah. I've worked with large investment groups in the past and invested everywhere from the East Coast all the way down, in Arizona and California. I mean, all over the country. And this is a really hot topic. And for the, first time in 20, 30 years of real estate experience over the last couple of years, the place to be investing is in Utah, which is awesome because that's where we live. And so we're familiar with the areas. So I get a lot of questions every day.
people asking me, should I invest? How can I invest? What's the market like? What do we expect to happen in Utah? Where do you find the money to invest? What types of property should I invest in? Should I do a traditional rental? Should I do a flip? Should I do an Airbnb? Should we look at executive rentals? Should we look at some other type of investment? And so I talk to people every single day about investing, and it's getting to the point in Utah where, honestly, in my opinion, everybody that should be investing in real estate as a long-term investment vehicle. You can make money with flips and shorter term things, but everybody should be owning real estate, specifically in Utah right now. So let's start with kind of a question that I'm asked very, very often. Is Utah the place to be investing right now? And my answer, I kind of just keyed you in on that, but my answer is absolutely yes. Utah is the place to be investing right now. I spent some time this morning just double checking my stats and going over numbers for this seminar. Utah right now, by the federal government, is rated as having a 2.9% unemployment rate. Many states around the country are well over 8%. And during this COVID pandemic, some states have been up over 20%. So Utah has the lowest unemployment rate in the nation right now. And you can go to the Bureau of Labor and Statistics and pull that up. U.S. News loves Utah right now. Utah is the #1 state on their ranking of overall economic outlook. Ranked #1, and some of the states surrounding us come in right behind us: Colorado, Idaho, places like that. But Utah is ranked the #1 state in the nation for economic outlook. Utah is consistently ranked in the top 10 and often the top 5 places for best places to start a business. And in that, they're looking at affordability, they're looking at government regulations, they're looking at disposable income in the area, and things like that. Utah's, in every report I've seen, they've been in the top 10. In every report that I've seen, and here's another one from U.S. News, but other reports back this up, Utah consistently ranked in the top 3 best states to live in, and they do tons and tons of factors, from affordability to job and economic outlook to quality of life and everything like that. Consistently in the top 3 best places to live. And Utah is also ranked as one of the fastest growing states. Every report I've seen puts us in the top 5. I think Idaho beats us in some reports, but so we're fast growing. We have a great economic outlook. We're ranked as a great place to live. Everything right now points towards the population boom in Utah to continue. I mean, if you're sitting in California or Portland or Seattle or New York, all these places Phoenix has some struggles with unemployment things right now, and you're looking for places to move, Utah pops up on almost every suggestion. With that, demand stays high. And people in Utah, we know that the market is hot, right? So a lot of homeowners, when they go to buy a home, decide to keep the house that they're currently living in and keep it as a rental, which sometimes can be a good idea. Sometimes there's better things that you could do, but we have a historically low amount of inventory available. So a very low number of homes available on the market, very high demand that looks like it will continue. And anybody that's taken any kind of economics knows that when supply is low and demand is high, prices increase. And historically, over time, real estate prices always increase. So let's talk first about real estate as a long-term hold. In my opinion, this is probably the best way to look at real estate investing. Now, a lot of people do flips, and we're going to talk a little bit about that. There's a lot of other things we can do with like infill developments and things like that. And we'll talk a little bit about those types of things. But as a general foundation for real estate investing, investing long-term in real estate, buying a property, holding it as a rental home over time, historically has always been a proven winner. So let's just run some numbers here. And I kind of pre-looked at these numbers because I don't want to run stuff on the fly. So I'll reference my sheet here. But as an investor, let's say you're putting 20% down on a property. Let's say you buy a house for $350,000. So 20% down is $70,000. Let's just hypothetically assume that gives you a mortgage payment of $1,600 and that you can rent the house for $1,700. There's a pretty good chance you could find a property for less than $350. Your payment could be less than $1,600 and you could collect more than $1,700 rent, but I want to be fairly conservative. Let's also just assume an annual appreciation rate of 7% over 5 years. Just so you know, the last couple years, probably 3 years in Utah, we've hit double-digit inflation, or not inflation, appreciation. I know several years ago, homes went up about 10%. I believe last year was around 12. Looking in the state of the market that we just did, the end of first quarter 2020 to the end of first quarter 2021, which was all through the whole COVID pandemic. Some statistics indicate we were over 15% appreciation. I've seen other numbers that indicate we were over 19% appreciation, but we're going to run this with just a flat 7% appreciation. In my ideal market, we go up 3 to 5% per year, but historically, Utah has been doing much higher than that. And so we're just going to go with 7%. So after 5 years, at 7% appreciation on a $350,000 house, you have made about $140,000 in appreciation on your home. As you've been paying your mortgage, assuming you're not paying early and things like that, you've probably paid down about $30,000 in mortgage over 5 years. Historically, they say rents go up about 3% annually. I think in Utah, we're a little bit higher than that, but again, we want to use conservative numbers. So at the start of this 5-year period, if your payment's $1,600 and you're renting for $1,700, you're pretty much breaking even. I mean, you have some maintenance and some management. You may even have a slight loss on the monthly rents. But by the end of that 5-year period, if rents just go up 3% per year, you're sitting at almost $300 a month cash flow on your rental. So if you count all of that up, and let's actually not count the rent part of it, the cash flow on rent, because like I said, there will be maintenance and management and things like that. So we'll just consider that a bonus. Between appreciation and principal pay down on your mortgage, in 5 years, you've made about $170,000. And your total cash investment was your down payment of $70,000. Not a bad return in 5-year period to turn $70,000 into $170,000. Now, what if you're a first-time home buyer or you're renting right now and you want to invest? I mean, we all want to invest, but how many times could the average person take a $70,000 payment and say, I'm going to buy that house. Okay, now I got another 70 for this house and another 70 for this house. The average person couldn't do that very many times. So let's say that you're just getting into the game. Maybe you don't even own a home right now. Your first home should be an owner-occupied home that you're moving into. It absolutely is an investment. It's just a really good one that there's even some tax benefits to doing and situations where you're not even taxed on the gains that you make. So let's take the same example, $350,000 loan. Let's say that you put 3.5% down. Now, we've just closed 2 houses for people. Closed one and another one's under contract and we'll close in a couple of weeks, where they had no money down. And I think we got their total closing costs all the way down to less than $2,000. So literally people are moving into homes with just a couple $1,000s. But let's just say 3.5% down, because that's a pretty typical FHA loan, fairly doable, about $12,000 out of pocket. Let's take the same appreciation. We're just going to say your mortgage payment's probably somewhere between $1,700 to $1,800. Depends on what your homeowner's insurance and what the property taxes are. But you're paying around $1,700, $1,800 a month. By the way, a lot of people are subsidizing that rent by renting out basement apartments. I have some buyers that just bought a house in Springville that closed a month or 2 ago, and it had a basement apartment in it. And the buyers actually chose to live in the basement apartment and rent the top out for $1,700 a month, so now they're living for a couple $100 a month. But plan on a mortgage payment on a $350,000 house. You're probably around $1,800 somewhere. Let's take the same appreciation rate. If the house, appreciates about 7% per year, that's about $140,000 over 5 years. You've paid down your mortgage a little bit more because on owner-occupied properties, your interest rate is lower than what it would have been on an investment property. So you've probably paid down around $40,000 on what you owe on your loan. So not counting any, like we rented the basement out or rented out an RV pad to the side of the house, like you can do with neighbor.com. Not counting anything like that, you've probably made about $180,000 in 5 years if those numbers hold true. And you've invested, in our example, $12,000. So calculate that return on investment. $12,000 in, wait for 5 years, you've made $180,000. I mean, that's pretty. That's a pretty good return on your money. Now, I kind of had to divide that and say, about how much is that per year? That's about $36,000 a year. I would challenge everybody watching this video that does not currently own a home to go into your boss tomorrow or Monday and ask them if they'll give you a $36,000 a year raise for not doing any extra work and see what they say, see how they like that. Because I mean, essentially, you buy a house and you've just on paper given yourself almost a $40,000 a year raise. And the cool thing is about owner-occupied properties, in many situations, when you sell that home, you do not pay any taxes on the gain. If you've lived in the home for 2 of the last 5 years, you should not, or most likely will not be paying any taxes on the gains. So what a lot of people are doing is we put together a plan where you buy your first house, you live in it for 2 years, you go and buy another house. And on this first house, after you've moved out, a little less than 3 years, you turn around and sell it because now you've lived in it for 2 of the last 5 years. You're turning around selling the house. Maybe you're making $140,000, $180,000 on it, and you take that money. Now you've been living in your next house for a little over 3 years. You take the money from the first house, go and buy another one, and then keep your second house as a rental for almost 2 years. And then you sell that one and take that money, and you've been living in your third house now for about 2 years. You take the money from the second house that you've sold, you go and you buy another house, and you're moving essentially 2 years and then 3 years and then 2 years and then 3 years. And every time you do that, you're putting, hundreds of thousands of dollars in your pocket, rolling it into the next property. And, by the time you retire, assuming you want to continue working a standard 30-year job and retire, well, you've owned 10, 12, 15 properties and been rolling the money in next and next and next, and you've got millions of dollars. So you could become a real estate investor just by living in the home that you're living in. So why invest in real estate as a long-term hold? I mean, rent adjusts with inflation. Rent, as cost of living goes up, so does rent. You've got a base asset where it's appreciating in value, and you can take a monthly income draw off of that. I mean, I would challenge you to talk to any financial planner and ask for what you could add to your portfolio that will increase in value while paying you dividends that self-adjusts for inflation, and see how many different options they can come up with. There's not too many. So yeah, real estate as a long-term hold is phenomenal. So if you're doing that, here's the next question that a lot of people ask. Do I hire a property manager? Do I manage it myself? And really, to answer this question, it kind of depends a little bit. If you're buying a home that you're moving into and you're going to rent the basement out, or you're going to live in the basement, rent the top out, probably you can manage that yourself. I mean, you're right there. You're gonna know the tenants that are there. Not too complicated of a situation. If you're planning on having the home that you live in with or without tenants, and then one other house, you're doing the 2-year, 3-year, 2-year, 3-year sales plan. You're only really ever going to have your house and one other house at a time. Probably can manage that on your own. If you're a professional, you're an attorney, you're a doctor, you're a CPA, you're a successful software engineer, you're somebody that has another job, or you're retiring and you're moving money from a 401k and you want to put it into something that will continue to appreciate while you're taking draws. Ask yourself the question, are you doing this to basically to start a business. Because if you're managing your own properties and you're buying 3, 4, 5, 6 properties or more, you're essentially starting your own property management company. And is that the goal of what you're doing? Or are you just wanting to invest in some appreciating assets that have different tax advantages and things like that? If you're not interested in really putting time into it, I would suggest hiring a property management company. You're not looking for a second job in that situation. You're looking for a kind of a perpetual investment fund that you probably don't want to be putting the time in to manage. And it's really not that expensive, honestly, to hire a property manager. There's great companies that I can refer you to that typically charge about 7% of the monthly rent. So if you're renting a place out for $1,700 a month, you'll be paying a little less than $120 a month for the property management company. Now, you still have all the maintenance and repairs and things like that. And most of these places will have you set up like a slush fund they can dip into and do repairs, and then you'll replenish that and things. But typically, I mean, comparing apples to apples, you're paying about 7%. So the next question, where do I find the capital, right? Because everybody's in a different spot. I work with people that have, excuse me, dropped my paper here. I work with people that have, a lot of assets sitting around. I have clients that every year come and they get a sizable bonus from their partnerships or companies that they're from. I have people that are coming with, 20 years of investment savings that they're wanting to diversify, all the way to, like I said, people that, we're just starting out and you don't have thousands and thousands of dollars sitting in the bank. So we've talked about owner occupied. We've talked about zero down for owner occupied. I mean, literally you can get into the investment game with nothing out of pocket or very little out of pocket. I mean, you still have costs of, you want to get a home inspection and things like that, but very, very minimal amounts of money out of pocket. I know people that have inherited a property and own it free and clear. It's very easy, very inexpensive to put a home equity credit line on that. Or if you're okay leaving it on there, you actually just do a cash out refi. You get a very low interest rate because you're living in the property, and you can take that money and go and pay cash for a house or use it. You get $300,000. That essentially can buy you 3 properties that you're putting 20% down on. So home equity credit lines are good. And if you're thinking of doing that, I know of several credit unions in the area that don't even do an appraisal these days. There's no fees to do it. And their only kind of caveat is if you close it within the first, I think, 3 years, you pay them for the appraisal for $350, which sometimes doesn't even apply because they didn't do an appraisal. They just look at your house. They say, oh yeah, it's worth, at least this much. We can get you this much money easy. So I can make some recommendations for home equity credit lines. I have conversations with people all the time that, in fact, I just had one this morning of somebody that said, we've got this investment property. We have hundreds of thousands of dollars of equity in it. I'd like to sell it and have access to that money. My spouse wants to keep it because it's such a good property. I would suggest that we can have a conversation about doing both. Why not, keep the property, refinance it, pull some cash out and use that to go and buy another place. So lots of options there. We talked a little bit about diversifying, funds out of stocks, retirement accounts, and things like that. I am not a big fan, especially for long-term investment holding. I am not a big fan of using hard money or bridge loans. Now, there's a place and you can do it, but even if you find a really good one and you're paying a couple of points, you're paying $5,000-$6,000, and typically you will not be able to refinance out of that property depending on how you structure it for 6 months to a year to get that cash back. So typically hard money bridge loans, private investor equity loans, and things like that are a very expensive way to hold long-term properties. But we can talk about that. There are some instances where that can actually work out for you. So Um, Next question that should come up is, where do we find these properties? Because, honestly, once a property hits the MLS, these days they're getting multiple offers, often within the first couple of days. Some of the offers are cash, and they can go very quickly. However, I would suggest that you can still find some very good deals on properties. We actually have one we just closed, two that we're closing, and then two more that are coming up for investors that were MLS properties. Now, all kinds of different factors can go into finding a good deal. Sometimes they need a little bit of work, and you can do some fix up. Sometimes an agent that lists the property for sale isn't really up on what the property is worth. And, so maybe there's a property that's worth 310 and the agent lists it for 290. It will get bid up, but maybe not all the way to 310. Typically the lower that a price of a property starts, the better chance there is that you can have equity at the purchase point. But so you can find deals on the MLS, and there's ways to make your offer look very attractive without paying $30,000 more. I mean, anybody can go and just pay more for a property than what it's worth and beat out other bidders. But there's ways to make offers very attractive. I mean, we find out what the sellers need. Do they need money to close on their next house, but they don't want to be homeless for a month in between? We can offer lease backs. And are they looking for a fast close? If you have the option of doing a home equity credit line or something, we can be offering cash. But you don't have to. I mean, with short due diligence and waiving appraisal deadlines and good amounts of earnest money, I think in the last couple of months, we've had 5 or 6, maybe 7 properties that people who do not have cash have succeeded in bidding on and having their offer chosen, and they're still getting good deals on properties. So there's a lot of strategy that can go into that. So I guess in summary of the MLS idea, don't discount that. I mean, I had a conversation with somebody yesterday that said, we really would love to invest, but once a property is listed for sale, haven't we already lost out? and I would caution you to not throw out the idea of investing because it's going to be hard to find a property. Just be okay with the idea that it might take a few weeks to look around before you find something. If you've got a very effective agent, they should be coming up with potential properties that are not on the MLS yet, but that are coming up for sale. I just looked at the last count. In the last 60 days, I've had 189 people ask me what the value of their home is. Now, over half of them are not considering selling. At least they say they're not. They're just curious of their value, like we all are. I mean, what's my house worth after this last 3 months? Someone told me properties have gone up, 7% in 3 months. Is that real? So a lot of people that are asking about properties aren't thinking of selling them, but a lot of people are. I mean, I have a list right now of probably 30 to 40 properties that they're considering selling. All it takes is for somebody to go and say, hey, I'm really interested in your property. I love your development. It's a beautiful area. What would you sell for right now? I mean, if we were saying we can close on this in 30 days, how much would you sell for? And often you can get great deals doing that. I mean, they know that their property's gone up a lot. And I may even do a valuation for them and say it's worth 375. And in their minds, they're just thinking, man, that just blows my mind. How could it be worth that much? If you pay me even 350, we'd be running out the door with bags of cash in our hand. And now you as an investor, you're getting a property for $25,000 under market value. So a very effective agent will have properties that could be coming up for sale that have not hit the MLS yet. As another place to go. You certainly can look at doing mass marketing, sending letters out to specifically targeted types of properties. Now, I mean, anybody that owns a home, I would love to do an online poll right now and just have everybody type in the chat, like, how many letters have you gotten, or postcards, little yellow postcards have you gotten in the last month saying that I'm interested in buying your house for cash? Every once in a while, somebody will say, oh, that sounds good to me. I just want to get rid of it. But most of us know, I mean, if someone is an investor and is going to be offering me cash for my house, 99% of us would say we know that they're not going to be paying market value, right? I mean, that's how they make their money. They can't pay you exactly what it's worth. So a lot of people are fairly skeptical about mailers, but if you're interested in kind of drumming up business, let's have a conversation, because we have some very effective mailers that go out that can be extremely attractive to home sellers, homeowners that aren't sellers yet, but that can also aid you in what you're doing with real estate. Picture if you were a homeowner that's kind of kicking around the idea of selling. Maybe your house needs a ton of work, outdated kitchen, outdated flooring, popcorn ceilings. I mean, needs a new roof. The windows are old, and you look at it and you think, there's no way I can spend $70,000 fixing my house up, but I know I could make more money if I did. What if you had written a letter to that homeowner and said, I've got a couple of different options of how I could buy your house. First, I'll just pay you cash and you can be done with it. Second, we could throw it up on the MLS and at a little bit higher of a price than what an investor would pay, and you can just take it. Or we have the potential of partnering with you. We cover the cost of the repairs. We set a base value for your house. We do all the fix ups. We sell it, and anything above that base, we split. Now, I mean, think about that. If a homeowner decides to do that with you, and you protect yourself legally and protect your investment, you just picked up a house without the entire loan, without the down payment. All you're paying for is repairs, and then you're selling it as a joint venture and splitting profits. So there's all kinds of ideas like that you can do if you're wanting to do mail outs and mailers. Talk with me, and I can help you with that. Just the idea for mass marketing is you've gotta offer something different. You can't offer this the run of the mill thing, or they're just going to chuck it in the trash. Let's talk just really quickly. If you are looking at a long-term hold and you're wondering, boy, how much can I rent my property for? How do you know that? Where can you research that? I would suggest not using Zillow. I would suggest not using Facebook Marketplace. You want a place where there's a large number of properties that you can actually search location and pricing and type. I'm going to share just really quickly a website here that I use frequently to assess values. And let's see if I can get this in the stream. There we go. I'm going to hide. What this comparable property has for rent. So I use rentler.com all the time, and I always like my investment clients to go in and look up properties on their own too, as opposed to just relying on me to give them that rental amount, because you want to be educated with what you're doing on your property. So okay, I think that's a pretty good discussion on long-term rental holds. Actually, let's talk about one more thing before we talk for just a minute about flips. Really understanding the numbers of the long-term rental. Do the math. It's really not hard math. If I'm saying, okay, what if my property only went up 5% per year? Well, you take the current value of the property, 350,000, and you times it by 1.05, and every time you hit return on your calculator, that's another year. So if you want 5 years, it would be 350,000 times 1.05. Enter, 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 and that'll show you how much it should be worth in 5 years if that was the appreciation. Knowing how to look up rents on your own. And really assess, and you've got to be honest here. I mean, don't compare, some of those properties that we saw pictures on Rentler are brand new properties, new flooring, new paint, new cabinets, new kitchen. If that's not your property, don't use that as a rental comp. Don't think like, well, they're asking 2,000. I mean, mine's not quite as nice. What if I ask 1,900? Find properties that are similar and compare that. And once you understand your numbers, a lot of that anxiety of should I jump into the market or should I not can go away. I mean, because you understand the numbers. And I would suggest talking to a lender as well. And we've got great people we can refer you to. The best lender in Utah, in my opinion, works with our team and will be more than happy to sit down and tell you, can you even get approved to buy a house? It's interesting, about half of the people that contact me saying I'm looking to rent, not to buy a rental, but to rent. I ask them, have you ever thought about buying and starting to build your net wealth and net worth through owning real estate? And they say, well, I don't know if I could be approved. About half of the people that we send in for a loan application would be able to get a loan within the next 3 to 6 months. So if you're kind of in that boat, like, I don't know if I could do this or not, let's put together a plan. Even if it's a year out, we can help you get ready. And if you're a seasoned investor, or but not necessarily in real estate, run the numbers. If it appreciates at this, if I put this much down, if I pay off this amount of the mortgage, all of that you can look at online very easily and understand what that investment could represent in 3 years or 5 years, or even better. I mean, if you're looking at a 20-year investment, the numbers will really start to blow your mind. So understand the numbers, and that will help overcome some of the anxiety of jumping into the real estate market. And if you have any questions, certainly give me a call, send me a text, shoot me an email, Facebook me, whatever. Okay, so let's talk about flips. Because we all watch the home shows. I can't even count the number of fix and flip home shows that I've been watching since COVID started, and it seems like we're running out of shows that we can binge watch. But everybody's interested in that, right? Like, man, if I could buy a house for $300,000 and put $50,000 into it and sell it for $450, I've just made $100,000 on this flip. And so it's a hot topic right now. So a couple of cautions on this. First of all, labor is in high demand right now. So you've got to know your crews, and you've got to start to build relationships. Roofers, plumbers, window people, electricians, people that can do drywall, paint, flooring. You need to have good contacts of people that because there's crews right now that are 2 to 3 months out. And sometimes it can be helpful when you do know some of these people to say, hey, I've got a rental coming up. I want you to put me on your books. How far out are you right now? Oh, we're a month and a half. Great. Pencil me in. I'll even give you a deposit if we need to. I want to be in your calendar ready for you to schedule this workout on this house. As soon as you get a property under contract, you need to have all of your crews lined up and ready to go. Let's say you're closing, May 22nd, tell everybody, like, around May 22nd, give or take a day or two, you're going to get going on this job, and we want it done in less than 3 weeks. And they'll be able to pencil you in. So know your crews, run cost numbers, go in and ask the people that, if someone that does drywall and things, just ask, hey, what's a typical cost for this type of work, windows and things. Materials costs have gone up quite a bit because of shortages, especially with shipment issues and things with COVID. That's kind of getting fixed. But the cynical side of me says, even though the supply chain is getting fixed, I'm not expecting materials costs to drop. I do expect people that are selling materials to start making more money, and maybe materials costs stay the same. But I don't anticipate that all of a sudden lumber and cement prices are going to fall. They may go down a little, but I think I think some of the suppliers and people that are dipping their hand in at each stage of that chain are going to absorb some of the cost savings that come once supply chains are operating normally after COVID. So know your crews, keep on top of your costs. I hear people, sometimes I talk and we look at a house and they're like, man, this house is a mess. It's going to take $100,000. And a lot of that is just from inexperience, and I'm looking at it like all you need is a new kitchen, new flooring, new bathrooms, new paint. And that's not $100,000. It may look like a really nasty, ugly house, but don't make an emotional estimate on cost to repair. You make your estimate on cost to repair by having a professional go in and look at it, figuring out what you need to do, or is there hidden electrical issues, or we're going to have to rewire and things like that. Just as an example, I mean, we had a house that we did about 3,500 square feet. Extremely steep roof pitch, so roofing costs more. We did a whole new roof, we did new furnace, we added AC, we replaced all the windows, and there were a lot of windows. All new interior. I mean, we even ripped all the trim off. We took all the doors out and replaced hardware, all new kitchen, flooring, paint, everything throughout. We redid fireplaces, redid bathrooms, all of that. And I think we were at about 72,000 on that house. So just keep on top of your supplies. I see a lot of people that analyze their way out of an investment because they make an emotional look at a house and they say, holy cow, there's trash everywhere. When in reality, you can pay someone about $500 and rent a dumpster and your whole house is trashed out, meaning they take everything out for you. So be careful with that. And then I guess since I've mentioned, conservative estimates, it's important to be conservative. I mean, you don't want to go into a property and say, I'm going to make $150,000. Woo! But at the same time, you also don't want to overanalyze your way out of a property. There's a group, it's probably several groups that were going around for a while that were teaching you, like, you could become an investor and I'll train you and all of this stuff. And the numbers that they used, they said that you want a property that you want to buy it for 70% of the after repaired value. So once you've fixed it up, what will it be worth? You want to buy it for 70% of that minus repairs. I mean, you run those numbers on a $350,000 house, you're looking to profit $100,000 on a $350,000 house. If you're looking for those kinds of numbers, you're not going to find them in this market. Certainly not commonly. So be careful not to over conservatize your numbers as well. I've seen a lot of investors that could have done great in real estate, but they were so conservative on their numbers that they just never pulled the trigger. They wanted to estimate $200 a month for property insurance and $300 a month for county and city taxes and painting the interior of a house at $12,000. And it just, you'll never invest if you're over cautious in your numbers. But at the same time, you do need to be conservative, and honestly, if you look at a rental, you do want to leave some leeway, for what ifs. What if you're replacing drywall and you notice that you've got huge electrical issues and you have to repull all of the electrical? You want some contingency funds. But when it comes down to it, if I'm buying a house for $300,000 and I'm putting $50,000 in it, and I'm able to sell it for $400, that's fine in my books. Honestly, if I really have my numbers drilled down, if I could buy a property for $300 and I'm putting $30,000-$40,000 into it, and after that I can sell it for $370, I'm probably okay. You do 5 or 6 of those a year, and you've just made 3 times the national average household income. So, I would say do not ever take more than a month on repairs. You need to get really, if you're really going to become a professional flipper, don't take more than a month on repairs. And there's some things that are kind of common sense, like, okay, you do all your painting before you put the new flooring in, so that you don't have to go back and clean flooring, and you don't have to tape, and you can spray paint and things instead of brushing and rollering and things like that. But some of the other big things where people get hung up, on one of the first rehabs that I did, I didn't even think about templating countertops. And so we were trying to hit that 1 month date. We got all the paint done, got all the flooring done. And then we had cabinetry people come in and do all of the cabinets. And then we're like, let's get granite. And we had the cabinets on order, I guess. They hadn't come in and laid them yet. We went to the granite place and we're like, hey, here's the blueprints for our cabinets. They're like, oh, we don't work off of blueprints. We come in and actually template your cabinets that are existing. So they couldn't even plan the granite until we had cabinets and countertops, or not countertops, base cabinets in, and they came and they actually made a model, and then they brought it in and cut the granite. And that's the best way to do it. But that delayed us 3 weeks, because from the time that we had the granite templated, the company wanted 2 weeks to cut because of how busy they were, and then about a week to schedule and install. And then we put the sink in and things like that. So it kind of delayed us. So be good at scheduling, and don't schedule more than a month. If you're worried about, what happens if I'm doing this rehab and the market crashes, if you get your rehab done in a month and you're taking pictures after 28 days, and then you're going live with your listing after 35 days, the market isn't going to tank to a point where you're going to lose money in 1 month. Now, if you bought it wrong and paid too much and things, you want to be careful of that too. But get your property done in a month. Don't mess around with how long it takes. You can have people doing roofing, windows, landscaping, demoing a property. All of that can happen day one. And then you get your crews to go in, you get the paint done, then you get the flooring people in, you get the cabinets, ordered initially, have your blueprints done for your cabinets initially, get those ordered. And then by the time paint and flooring's done, you're throwing cabinets up, and be good at scheduling. So, and plan for contingencies. Every property that you do is going to be a little different, and there will always be things that come up. And sometimes you'll get to the end, you're like, wow, we had budgeted $43,000 for this, and we only spent 37, and it's great. And you'll go the other way. You'll make a little bit more money, but always plan a little bit of a slush. I would say you probably shouldn't ever be doing a flip that you're making less than $20,000 on with some kind of contingency, unless it's just a ready to go and there's not a lot of work. You're just buying it, turning and reselling. But keep some contingency, because you don't want to work for free, and you certainly don't want to do all that work and lose money. And then, we talked about this just a little bit, but assemble your team in advance, all of your trades people, but also have a good agent that's going to know the schedule of your home, that can get in there and do the pictures. Have a good title company that can do your title checks when you buy and when you're selling. Have a good photographer. Probably the agent will be able to hook you up there, but have a great lender. I mean, these are people that you're going to be working with consistently. If you could make $30,000, $40,000 on a property, and you do one every 2 months, takes you a month to find it, buy it, fix it, sell it, and then you're buying the next one, and you do, let's say 6 properties a year, and you're making 30 to 40,000 on them. I mean, you could be making $200,000 a year. Don't cheap out on your team. Hire professionals to help you. And I would honestly say, for the most part, if you really want to turn this into a business, you shouldn't be doing the trades work yourself either. Now, initially, maybe you do that to save cash and things. If you have, if you have good skills and you can save that, and you want to have your crews have something to do with things. But for the most part, if you're doing this as a professional business, you're hiring other people to do the work for you. You're not doing it yourself. Okay, so let's talk about types of investments, types of homes to consider. It'll depend a little bit on your experience level and what your goals are and things like that. But we've talked about long-term holds. If you're planning on keeping a property as a rental, determine the work level that you want, the price point that you're entering in. It may be very appropriate to buy a townhome or a condo with a garage, or single family, but realize with single family, you might get a little bit more rent, but you're going to be maintaining yard or hiring somebody to do that for you. And the amount of cash out of pocket will change based on the type of property and the price point and what they're selling for. So as you're thinking about types of properties that you're interested in, and as we're having a conversation, I would look at what your overall goals are, what your available cash on hand is, what your experience is, and what your interest level is too. I mean, we want to do something that we're interested in. If buying 10 townhomes is boring to you and you've got the capital and you've got the time, we could talk about different types of projects, infill projects, land development projects, and things like that. But your goals are important. How long are you going to be holding this property? Are you looking for cash flow, or are you looking for appreciation? Are you looking for long-term income with great tax advantages, or are you looking for short-term income and you're okay paying capital gains, short-term capital gains on a sale of a property? So, we kind of want to consider all of that. Back to the rental thing, I keep coming back to rentals because that's most everybody in Utah right now is wanting to hold because values are going up. But you want to consider the type of property based on the type of renters that you want to have in the property as well, and what your preference is for that. For me, properties in that 3,000 to 4,000 square foot range, I hate them, especially if I'm close to a university. Like I live, 15 minutes from almost 80,000 university students. And so I put a house on the market that's, 3,200 square feet, and I'm getting calls like day in and day out every day. Hey, can we fit the soccer team from such and such university? We all want to live together, and that goes against city zoning and codes. And so you want to be careful about your size of your home. However, though, if I was up in like the Lehigh, Draper, downtown Provo area, and I was interested in doing a furnished executive rental, maybe that's a perfect size. So think about that. Are you looking for long-term rent? Are you going to do a mid-term rent? There's a lot of people right now that they've got this gap between selling their house and buying a new house, and there's a need in the market for properties that are 6-month